You know, the dream for so many business owners is building something amazing
Yeah,
and then really knowing the perfect way, the perfect time to sell it, get the best outcome.
absolutely. But actually navigating that sale, that's often the really challenging part, even for super sharp entrepreneurs.
Exactly.
Yeah.
So today we're doing a deep dive. We're digging into the art, maybe the science too, of selling your business. We're pulling insights from John Warrillow's book, The Art of Selling Your Business.
And what's really interesting about Warrillow's book is its focus. It's laser focused, actually. He's not talking about starting up or even the long haul of building value over decades.
Yeah.
He's zeroing in on the sale itself,
Yeah.
the actual process. His whole aim is to kind of demystify it, make it less overwhelming for owners like you.
Right. Equip you, basically. And it's not just theory, is it?
No, not at all. It's grounded in his own experience. He's sold businesses himself. Plus, he's learned so much from hundreds of interviews on his podcast, Built to Sell Radio.
Talking to people who've actually done it successfully.
Yeah, exactly. Entrepreneurs who've navigated that exit.
Yeah.
And he's really interested in that fuzzy stuff, the goodwill, what accountants call goodwill. It's more than just chairs and computers.
Yeah, the intangible value. So our mission today for this deep dive.
Pretty straightforward, really. We want to give you a really solid handle on the crucial things you need to know when selling your business. Make you feel informed, empowered, in control.
Instead of just lost in all the M&A jargon.
Precisely. Ready to make smart moves, not feel like you're just drifting.
Okay, let's jump right in then. The book starts with a question that, well, it seems basic, but Warrillow says it's fundamental.
Yeah.
And often overlooked.
Yeah, it's simply, what's really driving your decision? Why sell now? It sounds obvious, but really digging into your why is critical.
He frames it as push versus pull factors.
Right. Are you being pushed out by negatives? Like burnout, boredom, maybe partner disputes?
Or is something positive pulling you towards the future? A new venture, a lifestyle change, that kind of thing.
And his warning is pretty stark, isn't it? If it's only the push factors.
You might regret it.
Yeah.
Selling just because you're exhausted or fed up after pouring your heart and soul into building something.
Mm-hmm.
It might not feel great later on.
Which brings us to that Sean Oshman story he shares. It's quite illustrative.
Yeah, tell us about that. Turning 30 was the trigger, right?
It was. He sat down, made a 10-year vision board, and on it, a very specific pull goal. Living on a yacht by the time he hit 40.
Okay, that's pretty specific.
Definitely. So
Yeah.
he built his IT services company, I Support You, strategically with that end goal always in mind. It wasn't just about the business itself.
So what does that tell us? I mean, having that clear personal vision, not just financial targets,
Mm-hmm.
does that actually help the outcome, even financially?
I think it absolutely can. For Sean, he wasn't selling because he hated the business. He actually liked it. But that picture of life on a boat, that was the real pull. So he focused relentlessly on recurring revenue. He hired someone to take over his own role. He even started taking long holidays to test if the business could run without him.
Setting it up to be sellable, essentially.
Exactly. And guess what? He sold it just after turning 39, got nearly 3 times SDE sellers' discretionary earnings.
Okay, SDE, remind us quickly.
Basically, it's the profit an owner-operator could take home after adding back certain expenses. Now, Warrillow points out 3x SDE isn't earth-shattering for a small services firm.
That's for Sean.
He was thrilled. He hit his personal goal. He was literally living on his yacht, spearfishing. Genuinely happy. The money was great, sure, but it served the bigger vision.
It really makes you think, doesn't it? What are your aspirations? What would truly motivate you to sell beyond just wanting out?
It really does. Okay, so moving on from the why, there's the when, timing. Everyone wants to sell at the absolute peak rate. Hit the jackpot.
Naturally.
Yeah.
But Warrillow kind of throws some cold water on trying to perfectly time the market.
He does. It's so tempting, obviously, maximizing the return. But he gives us this really interesting contrast, looking at Rod Drury and Rand Fishkin.
Okay, let's start with Rod Drury, Aftermail. Sold pretty quickly, within 3 years.
Yeah, just 3 years. Sold to Quest Software, reportedly for around $35 million. For a young company, that's significant.
So what was the thinking there? Why sell so early?
Drury was smart. He saw the huge risks and challenges of trying to go it alone, trying to dominate a brand new market as a small independent player.
Right.
He realized Quest, with their massive Fortune 500 client list and resources, was way better positioned to really scale what he'd started. So it was a strategic, calculated move, not just holding on for dear life.
And it worked out well for him despite the company being young.
Seems so.
Okay.
Now, contrast that with Rand Fishkin at Moz. This is, well, it's a bit of a cautionary tale looking back.
Okay, what happened there? HubSpot came knocking.
They did. Offered $25 million cash and stock, which was almost 5 times Moz's revenue the previous year. A strong offer by many metrics.
But Fishkin thought it was worth more.
He did. He believed Moz, as a fast-growing SaaS company, had way more potential. He even countered at $40 million. I mean, what biases do you think push founders to maybe overestimate the future and undervalue a solid offer right now?
Yeah, it's a tough one. Optimism bias, belief in your own creation, maybe just fear of leaving money on the table.
All plausible. Anyway, HubSpot said no to the counter. Fishkin decided to raise VC money instead, diversify beyond their core SEO tools.
And that's where things went sideways.
Pretty much. The new products didn't take off as hoped. They shifted focus away from their really successful SEO core, and the company started losing serious money.
Oh, wow.
Yeah, by 2014, it was crisis mode. Fishkin stepped down as CEO. His own stake got heavily diluted. He ended up with way less personally than that original HubSpot offer. He even estimated later that the offer could have been worth over $100 million down the line.
Ouch. That's painful. Really highlights the danger of holding out too long. Or maybe just not recognizing a good deal when you see it.
Absolutely. So Warrillow's main point here isn't about becoming an economic forecaster. Forget trying to predict the stock market or interest rates.
Focus on your own business instead.
Exactly. Focus on the momentum, the trajectory, the excitement within your company. Sell when things are going well, when there's a positive buzz.
Yeah.
That's usually a much better indicator than trying to time macro trends.
That makes a lot of sense. Okay, so you've got your why, you're thinking about the when. Now, how do you actually maximize your position in the negotiation? Leverage. Warrillow talks about the slow reveal.
Yes, this is critical. Think of it like, well, he playfully calls it a striptease. You, the seller, control the flow of information.
Oh, elaborate.
It means you decide when to share what about your business. You release information strategically, piece by piece, to build interest, create desire, but without giving away the crown jewels too early.
And he warns strongly against these prop deals, right? Proprietary deals.
Oh, definitely. That's where one potential buyer convinces you to negotiate only with them, exclusively.
Sounds efficient, maybe, but what's the downside?
Big downsides. Once they lock you in, they know you have no other options. So guess what happens to their offer?
It probably goes down or
Yeah.
the terms get worse.
Exactly. Weaker offers, less favorable terms. Plus, they can drag out due diligence, knowing you're committed, and then try to chip away at the price right at the end. It puts you in a really weak spot.
But isn't there a risk they lose interest if you're too slow revealing things? How do you balance that?
That's the art, isn't it? You need to provide enough to keep them hooked, show the potential, but hold back the really sensitive stuff, deep financials, customer lists, secret sauce, until they're serious and under NDA.
He tells that story about the private equity group, the one that talked to 80 companies.
Yeah, that's a bit chilling. They were having acquisition talks, but it seems a big part of their motive was actually just scouting talent, identifying key people they might want to hire later.
And sometimes without even signing NDAs first. Wow.
It really shows the risk of opening the kimono too wide too soon. But he doesn't just warn, he gives solutions. Like Dan Martell with Clarity.fm.
Right, what did he do? He knew there were 3 likely buyers.
So instead of quiet, separate talks, he did something bold. He organized an event, invited all 3 CEOs, put them all in the same room.
Whoa. Talk about creating instant competition.
Exactly. They all knew if Clarity hit the market properly, they'd likely be bidding against each other. It immediately put Martell in a much stronger position.
So the takeaway for listeners.
Be really wary of those casual lunch invites from potential acquirers early on. Listen more than you talk. Definitely don't spill the beans on financials or key customers at that stage. Keep control of that information flow. The slow reveal.
Okay, controlled information flow check. Now, who do you actually send this carefully curated info to? Identifying potential buyers. Warrillow breaks them down into 3 main types.
That's right. You've got your individual investors, your private equity groups, PEGs, and then strategic acquirers. And each one is different with pros and cons for you, the seller.
Let's start with individuals. What are the key things to watch out for there?
Well, the story of David Chang and CS Design Builders is a good, if slightly cautionary example. He agreed to sell his renovation company to an individual.
Okay.
But then the buyer restructured the deal. Higher headline price, sure, but most of it was in delayed payments over years. And there was a clause. If the buyer missed payments, Chang could take the business back.
which sounds like a safety net, but I sense a bud coming.
You sense correctly. The buyer struggled, the business went downhill, and Chang ended up having to take back a company that was, well, a shadow of its former self. Major headache.
So the lesson is,
You absolutely have to vet an individual buyer's finances and their ability to actually run the business effectively, not just close the deal. Are they really prepared?
got it. Okay, second type, private equity groups, PEGs.
Mm-mm.
What's their usual game plan?
Their classic model is buy, improve, then sell or flip, usually within, say, 5 to 7 years. They want to grow the value and then exit.
But some are different. Family offices?
Right. Some family offices operate like pegs, but might hold businesses longer, focusing more on steady cash flow generation. They often have a longer-term outlook than traditional pegs and might be more interested in stable, ongoing income rather than a quick flip, which could influence their offer and terms.
And PEGs often use debt, right?
They do. They leverage debt to finance acquisitions, which means they usually look for bankable businesses. Companies with a solid, proven track record of profits that can handle the debt payments.
What's the potential upside for a seller with a PEG?
Well, Warrillow mentions the second bite of the apple. You might sell a majority stake but keep some equity, potentially staying on in a leadership role. You could benefit from the growth they drive before the next sale.
A chance to cash out again later.
Potentially. And they bring resources, expertise, maybe help professionalize the company, though that professionalizing might not always feel comfortable to a founder used to calling all the shots.
Fair point.
Yeah.
Okay, third type, strategic acquirers. Warrillow hints these often pay the most.
They often do. Strategics are usually companies already in your industry, maybe competitors, suppliers, or customers. They're buying your business because of what it adds to their existing operations.
Synergies, market share, that kind of thing.
Exactly. Synergies, market share, access to new tech or customers. Because your business is worth more in their hands than it might be on its own, they can often justify paying a premium.
He uses that Home Depot buying blinds.com example. That was interesting.
Very. Blinds.com was the biggest online blinds retailer. Home Depot, obviously, a giant in home improvement overall.
So why did Home Depot buy them? Just for the blinds market share.
Warrillow argues it was likely much more than that. Yes, market share, but probably more importantly, Home Depot wanted to learn from Blinds.com's really successful online sales and service model.
To apply it to their other products.
Precisely. He estimates that even a tiny, 1% improvement in Home Depot's overall sales just by applying lessons from Blinds.com could mean an extra $900 million a year in revenue. That's huge strategic value.
Wow. Okay. And he briefly mentioned hybrid pegs. What are those?
Think of them as a mix. They operate like a peg, buying and consolidating companies, but they do it with a very specific industry focus, like a strategic buyer.
Like the example of buying up lots of small dental practices.
Exactly. They gain economies of scale, purchasing power, maybe better systems, then potentially sell the whole larger group later. They have a strategic focus within that niche, even though they use a peg structure.
So the big message seems to be keep an open mind about all buyer types.
Definitely. But he does give one really practical piece of advice, especially for attracting buyers who need financing, like pegs or maybe some individuals.
Which is?
You need to show consistent profits on your tax returns for at least 3 years leading up to the sale. That's the proof banks will look for when lending money for the acquisition.
Makes sense. Clean financials are key.
Absolutely. And of course, if you've built something truly unique, something customers love and competitors can't easily copy, you'll naturally be way more appealing to those strategic buyers willing to pay top dollar.
Okay, so we understand the types of buyers. How do you actually build a list of specific companies to approach, moving from categories to actual names?
Right, getting practical. Warrillow points to Peter Kelly's experience selling OpenLane, that online used car marketplace.
What did Kelly do?
He focused his initial efforts, targeted just 3 strategic acquirers who'd already shown some interest in the past. Smart move. And it worked. He sold to one of them, Carrier Auction Services, for nearly $250 million.
So targeting can be effective. He also mentions different auction types. Broad, limited.
Yeah, the type of process depends on your business. A smaller company might go into a broader option, maybe listed with a broker. A larger, more complex business probably needs a more targeted outreach to a hand-picked list.
And proprietary deals. We already know the risks there.
Generally less likely to get the highest price, yeah. but maybe offers more confidentiality, less disruption. It's a trade-off.
He keeps coming back to the value of strategics, though.
Because they often have the deepest pockets and the best reason to pay more. Look at Steve Murch with vacationspot.com.
Ah, yes, the Expedia deal. He played the long game there.
Totally. He partnered with Expedia early on, gave their users access to his non-hotel listings in exchange for equity 20%. He knew Expedia was the natural, ideal buyer down the road.
And 3 years later?
Bingo! Expedia bought them for $87 million. Brilliant strategic positioning from the start.
But he says don't ignore financial buyers like pegs either, right?
Yeah.
Why keep them on the list?
Several reasons. One, just having them in the mix creates competition, which helps drive up the price, even if a strategic ultimately wins.
Makes sense. Leverage again.
Two, some financial buyers are actually strategics in disguise doing those industry roll-ups we talked about. Three, a peg might let you stay involved post-sale. Maybe you run a division, keep some skin in the game. That appeals to some owners.
Okay. And then he offers that handy 5 to 20 rule of thumb. What's that about?
It's a simple filter to help you narrow down your list. The idea is your most likely buyer is often a company that's between 5 and 20 times bigger than your own business.
Why that range?
Well, if they're at least 5 times bigger, they can probably afford the acquisition without betting the farm. It's significant, but not overwhelming for them.
And if they're more than 20 times bigger?
Then your company might be too small to really make a strategic difference to them, a drop in the ocean. It might not be worth their time and effort. So 5 to 20 is often the sweet spot.
Okay, that's a useful guideline. So you've got your list. How do you make that first approach? Generate interest without giving too much away. This is where the teaser comes in.
Exactly. The teaser document, it's usually just one page, anonymous, designed to intrigue potential buyers enough that they want to know more and, crucially, sign an NDA, a non-disclosure agreement.
He mentioned Sam and Visual Sonics.
Yeah, Sam apparently went through multiple drafts of his teaser, really refining it. Shows how important it is. And it paid off. Visual Sonics sold for $80 million. The teaser needs to be compelling, highlight the opportunity, but vague enough that they can't immediately figure out exactly who you are.
A balancing act. And what about explaining why you're selling in this teaser or initial contact?
Be truthful, but strategic. Remember, most buyers, especially strategics and pegs, will likely want you involved for a transition period, maybe longer.
And you don't want to sound like you're desperate to just run for the hills.
Precisely. Frame your reasons in a way that reassures them you're committed to a smooth handover and the continued success of the business. Transparency, but with strategic communication.
Got it. Okay, so the teaser worked. They're interested. They've signed the NDA. Now you need to give them the real detail.
Wow.
That's the CIM, right? The Confidential Information Memorandum.
That's the big one. Think of it as the official sales brochure, or really a detailed book about your company. It's a marketing document, fundamentally.
But it goes way beyond just features, right? It needs to show the benefits to the buyer.
Absolutely. It has to answer the question, what job will this company do for us, the acquirer? How will it make our business better, stronger, more profitable?
So it absolutely needs to be in a good CIM.
Okay, key sections would be a solid business overview, what makes your model unique, your competitive advantages, things they can leverage, product supplier details, ideally by revenue and margin.
Financials are obviously key too.
Crucial. Usually adjusted P&L for the last 3 years, plus projections for the next 2. And adjusted means taking out any one-off expenses, personal perks run through the business, maybe normalizing the owner's salary to a market rate.
And customer info.
Yes, but carefully. Descriptions of key customer segments, maybe anonymized examples, but you have to be cautious here.
Cautious how? Are there risks in sharing too much, even in the CIM?
Oh, for sure. Warrillow tells that story about Dinesh Damija of ebookers.com. It's quite revealing.
What did he do?
In his CIM, he included the specific hard-negotiated commission rates he had with hotels and airlines. Really valuable proprietary info.
And he sent this out after NDAs were signed.
Yep. Got 6 big online travel players to sign NDAs. But afterwards, he suspected that 4 of them were probably more interested in getting their hands on his commission data than they were in actually buying his company.
Ouch. Using the process for competitive intelligence.
Exactly. It's a huge warning. Even with an NDA, be incredibly thoughtful about what sensitive data you share and when. Maybe some things wait until even later in due diligence.
Right. Okay, so you've put together this compelling CIM. Now, the moment of truth starts approaching. Figuring out your number, the price. How do you tackle that?
This is super critical. Warrillow's adamant. You must know your minimum acceptable price, your walkaway number, before you start serious talks.
And this is a big but.
You never reveal that number to the buyer, ever.
Okay. So how do you arrive at that internal number? He mentions two key questions.
Right. First, what's your business objectively worth? This means doing the homework. Valuation methods. Asset valuation, what are the tangible things worth? Discounted cash flow, or DCF, what are the future profits worth in today's money, considering risk? And looking at comparables, what have similar businesses sold for recently?
Okay, so that's the objective side. What's the second question?
This one's more personal, more subjective. What's your business worth to you? This factors in the emotional stuff, the years of sweat equity, the sacrifices, what it means to you beyond just the balance sheet.
And he warns about one common mistake here, doesn't he? Anchoring on your retirement number.
Yes, big trap. Just because you calculate you need, say, $5 million to retire comfortably, that doesn't mean your business is actually worth $5 million to a buyer. They're separate calculations.
Your need doesn't determine their valuation.
Exactly. Don't confuse the two.
So the practical advice is, do your homework on valuation, using those methods, assets, DCF, comps, get a realistic range. Then do the soul searching to figure out your true personal bottom line, considering everything.
Right. And then when the buyer inevitably asks, so what are you looking for? What's your price? You politely sidestep.
You demur, exactly. Say something like, look, we're reasonable people. We'll seriously consider any fair offer you put forward based on the information. Let them make the first move.
Why is that so important? Letting them go first.
Because if you name your price first, you've just set the ceiling. You might leave money on the table if they were willing to pay more, or you might scare them off if your number seems too high before they fully bought into the value. Let them anchor the negotiation.
Okay, that makes strategic sense. So, as we start to wrap up this deep dive, let's pull together the biggest takeaways from Warrillow's insights.
Yeah, we've covered a lot, but the core ideas are pretty clear. First, really understand why you're selling. Get clear on those push and pull factors.
Then, think strategically about timing. Focus on your business's own positive momentum, not trying to perfectly time the market.
Build that negotiating leverage. Use the slow reveal of information. Create competition among potential buyers whenever possible. Don't get locked into prop deals early. Identify the right types of buyers for your situation, individuals, pegs, strategics, and understand their motivations.
Craft those marketing materials carefully, the teaser to generate interest, the CIM to tell the full story compellingly, but be cautious with sensitive data.
And finally, know your number, do the valuation homework, figure out your personal bottom line, but never, ever reveal it first.
Absolutely. You know, our goal here was really to take what can feel like a super complex, maybe intimidating process and break it down. Give you, our listeners, a structured way to think about it.
Hopefully provide some of those aha moments, make the whole idea of selling your business feel a bit more manageable, more insightful.
We hope so. Hiring your business is huge. It's more than just finance.
Definitely. Which leads to maybe a final thought for everyone listening to chew on. Selling is obviously a massive financial event, but it's also deeply personal, isn't it? It's tied up with your life goals, your identity sometimes.
For sure.
So thinking ahead, if or when that time comes for you to consider selling, what are the non-financial things, the factors beyond the dollars and cents? What will weigh most heavily on your decision? That's something worth really reflecting on.
Great point. And hey, if this has piqued your interest, definitely check out more from John Warrillow. His Built to Sell Radio podcast is fantastic, and he's got other great books too. Lots more to learn there.